I'm Josh Duvall, certified financial planner, registered tax preparer from Joshua Duvall Financial Planning and Accounting. Just wanted to bring this quick video to you today because there's a lot happening in the news. Obviously, geopolitics is taking over, news coverage and is having an effect on the market. So even in the midst of kind of tax planning season, normally I'd be talking a lot about that. But today we're going to be talking about Russia, Ukraine, and what it means for investors. So first of all, we need to kind of set the table as to what's happening. So you can read all sorts of coverage. This is not going to be a political video. I'm not going to debate about the reason why things are happening, but rather talk about what is happening, what has taken effect, and what that means specifically for investors who are trying to build wealth, plan for the future, and manage their taxes. So first off, you should know that the S&P 500 was under pressure, downward pressure, as a result of lots of things that have taken place as kind of an after effect of COVID, right? So we have inflationary pressures, which have hurt the markets. We have issues with prices in gas. We have issues with economic numbers as far as jobs reports, unemployment, earnings for companies, et cetera. So there's already been a downward trend. Just to start the year, the market was off about 5%. Now we're down to about 11 or 12% since our most recent high. Okay, so when you hear the term correction, what that usually replies to, people will say, you'll read a headline that says the US stock market is in a correction. What does that mean? It means that you've gone down 10% from the most recent high. So your most recent high was right at the end of the year, December 27th or something. The S&P 500 had peaked, and now we're off about 11.5, 12%, depending on kind of the index that you're looking at. But a basic S&P 500 is about 12% off. And so we've entered correction territory. Now, what does that mean going forward? Well, first, you have to understand that the geopolitical events that are happening between Ukraine and Russia are obviously going to have an effect. They're hurting European markets much more than they are US markets, but even Shanghai, Far East markets, developing economies, everything's going to feel the effects of this because NATO's we have a global economy, NATO's a global operation. And so, there's going to be concern throughout the markets. But the question is, as you're an investor reading headlines about Ukraine and Russia and the markets and all of the fear that comes along with that, the question is, what does it really mean for you? What types of steps should you take in order to insulate yourself from this, or to understand how this event in history fits into the broader context of you managing your wealth? So first off, I have to separate groups of clients or investors into two groups, right? For those of you that are, I'm going to use the word young, and some of you might laugh at that, but kind of in the 45, 50-year-old space and younger, you're in a building wealth phase, okay? Unless you're retired and you're living off of your assets, you're in a building wealth phase. And as crazy as this might sound, any downward periods in the market, any downtrends, if you're saving, if you're contributing to your 401k, you're contributing to your IRA, your Roths, you're actually saving money in brokerage accounts, taxables, etc. That's actually a good thing for you. Having downward trends in markets while you're a saver, while you're someone who's building wealth, is a positive. What does it mean? It means that you're actually able to buy more shares of ETFs, mutual funds, stocks, individual companies that you like, more shares of those investments for the same dollar amount that you were paying just a few months ago in December. So you're actually getting all of the companies that you like, the things you want to invest in right now at a 12% discount, just coming off of December of last year. If you went into your favorite store and you wanted to buy something that you'd had your eye on, seeing a sign that says 12% off would make you happy. It wouldn't make you frustrated. And so you have to understand that for people building wealth, short-term downward pressure in the markets is a good thing. You're able to continue to save and buy more shares at a lower price than you otherwise would have. What does that do? It pushes your forward projections of earnings and performance. It increases those projections. So it's actually a good thing. Now, for clients that are in a space where they're living off of their assets, or volatility is a major concern for them, that means these ups and downs that markets take really concerns them. You have to think about this event in the context of the time horizon that you have for all of your money, as well as those types of cash flow expenses that are very acute and short term. So what I mean is, if you're in a space where you know that you're going to need $100,000 from your portfolio in the next 6 months, you don't want to have that in the market. You shouldn't have had that in the market to begin with. So if you're in a space where you're pulling money out of your investments, you need to think about buckets of investments that have different avenues of risk in order to make sure that money that you need short-term cash on hand isn't going to be fluctuating as wildly as the stock market. The way that you have to think about that is, you don't want to be in a position to sell under pressure. If you need a down payment for a house, or you have a large debt that you're paying off, or you just need expenses to live, and now you have 12% less in your portfolio than you did a couple months ago, that's a frustrating place to be. But it's a symptom of a larger problem about portfolio allocation. You haven't constructed your portfolio in a way that's going to benefit you from a cash flow and risk management standpoint. Now, at any given moment, markets can be down 20% overnight at any given moment. It could be a mistake that someone puts in a keyboard. It could be a bomb going off somewhere, a terrorist attack. At any given moment, stock markets across the world are susceptible to 20% off the top at any given moment, any day. Now, people have been talking about this event in Ukraine happening for many weeks. There's been kind of buildup and all of this. A similar situation would be looking back at Crimea. We'd have to go back and look at the coverage of kind of what happened in February and March of 2014. Anything is going to be ramped up as far as from a fear standpoint. So if you're looking for something to be afraid of, the news will provide you never-ending resources and reasons to believe that this is the end. As an individual investor for myself who invests in 100% stocks all the time, I'm talking about myself, not talking about clients, but in the context of my life and my ability to build wealth over time, I do not believe that what we're seeing in Ukraine and Russia is going to lead to 30 years in the future having a worse economic situation in the stock market than we are today. Are the markets going to continue to fall? They very well may. But no world power is interested in some dystopian future where money doesn't matter. And so whenever people start coming to me about gold and run on the banks and cash and all of this type of stuff, the question really is, do you believe in the future that we're going to have an economy that flourishes, that we're going to have new technologies, that we're going to have economic growth, that we're going to have new technologies and inventions and things that provide value to individuals, that markets are going to continue to open up in third world countries and developing markets across the globe? Are those the types of things that you believe in, that kind of abundance mindset? I do. And this type of short-term geopolitical discussion, as much as we might want to talk about the US getting involved or what this means for gas prices. Could gas prices go up? Sure. Could the stock market go down? Yeah, of course it could. But what does that event over the next 6 months, even a year, what does that have to do with 20 years from now? So again, there has to be a conversation not only about current short-term risk or performance of the markets, but what that effect is going to be 5, 10, 15, 20 years from now. That's your time horizon that you need to think about. You have goals. Those goals need to be incorporated into your portfolio. You have a risk tolerance. That's what makes you not be able to sleep at night. That information needs to be able to be included into your portfolio. You have a time horizon. When do you actually need this money? And how should it be invested in light of your time horizon? That information should be included in your portfolio. You should have a holistic portfolio that incorporates these different variables to help you understand how you can be on a path to achieve your goals and understand the ups and downs that come along the way. So if that's the conversation that you're asking yourself about, if you're concerned about those types of details and you want someone to talk to, I'd encourage you to reach out. You can shoot me an email, josh@joshuaduvall.com. Obviously, financial planning clients, I'm happy to talk to you whenever you want. You can book with me directly through my booking link. As far as other folks that might be interested in kind of an advisor's perspective or a certified financial planner perspective on your investments, I'm happy to have a conversation with you. Would love the opportunity to connect with you and help you understand how your portfolio should be put together in order to weather these types of situations. Now, does that make you feel better if you're looking at your accounts and they're down $100,000 over the last 3 months? No, I mean, of course, that's frustrating, but ups and downs are part of investing. What we have to do is understand our allocation and look at these events in context of things that are happening over longer periods of time. You can go back to COVID in 2020. You can go back to the collapse of financial recession of the Great Recession of 2007 and 8. You can go back to the dot-com bubble and 9/11 and go back to any of these periods. People that sold out when the fear was at their absolute highest, got out of stocks and didn't know when to get back in, lost all of the upside. That's why I don't advocate for a market trading, for timing of the market, for having cash on hand, dry powder, all of those things. There's lots of strategies that people like to employ, and everything looks perfect in hindsight. Hindsight's 2020. You need a portfolio that you understand why you're invested the way you're invested. It's built to weather these types of events that could happen at any time. Today, it's Ukraine and Russia. 6 months from now, it'll be something else. A year from them, it'll be something else. Wall Street climbs a wall of worry. The markets are always moving forward. And what we want to be able to do is understand how to take advantage of those things as you're continuing to build wealth over time. I hope this is helpful for you. Again, if you're having issues related to kind of the way that you're feeling about your investments or questions about how this is going to affect you long term, I'm happy to have those discussions with you. Please feel free to reach out. You can reach me at josh@joshuaduval.com. Thank you so much. I hope you have a great day. Bye-bye.